Hello, everyone. My name is Aldiyar, and I am a portfolio manager for Quantum Capital, a boutique asset management firm based in AIFC, Kazakhstan. 2022 was a difficult year for many investors and asset classes. Will the situation improve this year? So to address this question, today we're privileged to have Stine Jakobsen as our guest. Steen is a chief investment officer at Saxo Bank, a Danish investment bank and global trading platform with substantial assets under management. Steen, welcome, and thank you very much for the opportunity to speak with you.
Thank you for having me. It's always a great honor, and I'm very excited about the new relationship between Saxo and Quantum. So welcome on board on hopefully a very profitable and healthy journey together.
Thank you, thank you. So before we dive into macro and market outlook, I thought it would be useful if you could say a few words about Saxo Bank. So Steen, who are Saxo Bank and what differentiates you from other players within the industry?
It's a great question, and of course something the marketing department is much better at defining than me. But from me being the trader, what makes Saxo unique, of course, is that we are a investment house. We are an online broker. But as many of you will know, in the online broker business, a lot of these businesses are non-banks. So what's unique about Saxo is that we are a fully licensed European bank and have been that for almost our entire history. And at the same time, we are state-of-the-art technology platform with probably, and you know this better than me, but one of the widest asset access in the world. I think we trade on a daily basis something like 60 to 70,000 different products on the platform. So what's unique is we are broker, we are a bank, we are licensed. We are so far privately owned, so the capital structure is very firm, it's very solid. And on the technology side, we feel that we may not be the best in the world, but we are certainly up there with the best in the world. And the final part, which is actually also why you and I talk today, is that what makes us stand out, in our opinion, in terms of research and market, is that we are an online bank, and yes, we are state-of-the-art technology-wise, but we have this personal touch where my team, which is a global team of 15 people, is accessible for you personally, but also your clients, if we in any shape or form can help or alleviate some issues or create some kind of direction. So that's personally what I'm most proud of, that we have this digital delivery, but also with a very personal touch that one can be tailor-made and secondarily can actually support clients of Quantum, but also clients directly of Saxo.
Yeah, I absolutely agree. So obviously, Quantum Capital's relationship with Saxo has just started, but what we've seen so far is a lot of support in terms of the onboarding process and really access to a great variety of instruments and a good balance between prices and execution. So moving on maybe to the next topic that I would like to discuss which is approach to investing and asset allocation. So obviously one of the efforts that you lead at Saxo is asset allocation. And I thought it would be maybe useful for our clients and prospective clients. Investing culture in Kazakhstan is actually in its inception, I'd say, and I think it will only evolve. But so far, it is mostly expressed through bank deposits and real estate investments. So what would be your advice to our viewers in terms of developing their personal approach to investing and approach to asset allocation?
So nothing wrong with bank deposits and real estate, obviously, especially last year, but also in the context. But you're right. So I run a advisory educational model called the 100-year portfolio, and of course, anyone listening to this will say, I'm not going to live to 100 years. Why would I be interested? But of course, the perspective here is to make clear to people that if you want to make money in the short term, you need to invest long term. And if you and trust me, I know I look very young, but the lack of hair and my bad physical form should indicate I've been doing this job for more than 30 years. And it's absolutely clear to me, as I sit here with more than 30 years experience, that the only free option we have in the markets is multi-asset allocation. So in other words, the only free option given by the market is your ability to harvest and invest in different assets, and through constructing a portfolio which is diversified, but also at the same time takes on risk in different shapes, you can actually formulate a strategy which conservatively should minimum give you the same upside as anything else in an up market, but which should do significantly better in a down market, which of course is to a large extent the biggest problem we have. I think you personally, all your clients has probably have the experience of having a stock rise significantly, but I think all of us also have to admit that we have been more damaged by the losses we made in our life than our positive trades. Using a multi-asset model actually allocates to this. So very simplistically put, in my model, I at all time run 35% exposure to equity. Of course, the latitude and the ability to do whatever you want in equity is very large. But what is important for your listeners is that when you make an allocation model, you need to fix the model from day one. So actually, the biggest work, the most important work as an investor, is before you even start. You may have, $200,000 in your account, but when you put on a piece of paper in going forward, I will have 35% in equity, 15% in bonds, for instance. Then you need to stick to that. What you put into the equity bracket, you can always negotiate with yourself or your advisors, but the most important part is keeping 35%. That's number one. So, remember, day one is the most important day. After that, it becomes pretty easy, because what will then happen in my models is that if, for instance, we have 35% equity exposure, and let's take this month, it's been a very positive month, but let's assume that January has been plus 10%. Then, of course, your 35% should have grown by 10% times 35, which is 3.5%. Okay, what does that mean? That means that my exposure now has risen from 35% to 38.5% exposure. What I then do is I sell the 3.5%, so I go back to 35. Similar, if the market is down, let's assume it goes back from 35 to 30 in terms of value, then I buy back to 30. So basically what you're doing by doing this, what is called monthly rebalancing, you are always averaging in, so you're always selling what is going up and you're always going what is going down, which means at the end of the year, you have the average price for every new trade done. And if you extrapolate that into the future, it's pretty simple. It's something that works. Why? It reduces the volatility on the downside because you rebalance. And it is by compounding the dividend yield, the buybacks that you have in equity, you are at all times not concerned about whether to be in or out of the market. You're always in the market, but your action you have when the market's going down is to buy. The action you have when the market's going up is to sell and put it into other assets. So in my case, to make it very short, 35% in equity, 15% in bonds, 10% in gold, 10% in commodities overall, which gives us to 70%. Then I have 5% in volatility long, which is kind of complicated, but not. It's really just buying a fire insurance on your market. And then I have exposure to different more illiquid, some like 20% in real estate, which you alluded to first, and then 5%, which is really sort of a lottery ticket that can be used to buy optionality. I continue to relocate all this asset allocation every month. So you can say it's kind of ironic. I'm CIO of Saxo Bank. I have all these opinions about the market in the past and into the future. But when I trade, I become a different person. I allow myself only to trade inside the parameters of 35, 15, 10, 10, 20, and 5. And I continue to reallocate that back. So instead of spending time on whether to be in or out of the market, I try to optimize what I have in equity, what I have in fixed income, what I have in commodities. So instead of playing with my allocation, I play with what is inside the buckets that you use. I don't think it's very complicated. It's kind of funny because a lot of young people think it's very difficult to get started trading. And I say it is probably the most simple thing in the world if you accept the premise that actually makes your money long term, which is compounding. So, getting dividend yield and yield and yield on bonds, the reweighting, and then accepting that you cannot control the investment. It's not about emotion. It's about extracting the premium you're given to hold assets which are illiquid. Of course, the most illiquid you can have is private equity and real estate. So the return profile needs to be bigger. The lowest yield will be deposited in banks because they are, 98% certain to be paid back and they can be accessed on a daily basis. So I think that is the quick sort of solution. I know to a large extent it sounds almost too simplistic, but let me give you one statistic that is important. So around the world, there are, millions of people who will tell you, I can manage your money better than the market. The truth is, however, if you only allocated 25 to equity, 25 to fixed income, 25 to commodity, and 25% to real estate, and did exactly what I told you to do, you personally, without doing nothing, having no opinion, would have beaten, and listen to this, you would have beaten 95% of all active managers in the world. So in other words, you can pay a lot of money to get someone else to do your job, or you can do the due diligence and the proper work in connection with Quantum and others who understand these principles. So someone who's a veteran, lost my hair doing all this, I really think this is the big good way to start. I am not going to stop anyone from speculating in oil or whatever, but just if you have 60, 70% minimum in this kind of multi-asset model and then play money from 10 to 30%, I think you're in a very, very good position because the 60 to 70 will keep you alive, will give an excess return relatively to the market. And particularly in a year like 22, it will protect you about a very, very negative downside.
Yeah, I think it's a great and simple approach, and in a way it resembles the mean reversion approach, which I like a lot. Steen, when you say 35% equities, 15% bonds, etc., would that be a kind of universal target allocation, or one could kind of tweak in terms of taking more equity beta or less equity beta depending on the situation that they have?
Not inside the model, but that's also why I talk about the classic investor would have two pockets of capital. One, which is, let's call it what I call it, the 100-year portfolio. That should be the majority, or the quantum model of 100-year. You should have 80% roughly in that pocket. And then on the 20%, you get to play with being underweight or overweight the equity market, buying call option on oil or buying call option on Microsoft, or this week in an earnings week, which is big like this week, you can play on some of the FANGs, Tesla, whatever you want to do. But I think you should split the capital in two pockets. The majority should be conservative long term, and then your play money, as I will call them, because we need to realize we have no predictability. We cannot. We can get lucky. We can get unlucky. We can do whatever. But at the end of the day, what really works is to think long term, even in the short term, and you will make money.
Understood. Yeah, and if we kind of dive into those categories, it would be great if you could maybe say a few words about what is inside those kind of buckets. We're mostly focused on equities. Of course, it would be great to know about equity, about your kind of insight within the equities, maybe bonds and the commodities. Interesting as well. And I think it's a pretty high allocation, 10% to commodities.
Yeah, and the backstory here is, of course, that it's built on the original model, 25, 25, 25, 25. So you can say 25% is sort of inside the realm of where that was. But on equity, I very much lean on the research done by the excellent equity team in Saxo, which is doing both a bottom-up and a top-down analysis. And as you may know, we were one of the first houses in the world to call inflation. We actually put out a very instructional video already at January 21, saying that inflation was here. So that, of course, made us overweight a little bit the commodity, relatively speaking. But let's take it in the order you ask and in importance, equity. So Saxo on a daily basis runs baskets, not baskets that we are selling you, but we have done eco-weight baskets bottom up. So we have a crypto, we have cybersecurity, we have logistic, we have defense spending, we have speculative stocks. All that kind is accessible for you and your clients on a daily basis on the analysis part. That basket tells you what is working and what is not working. It doesn't give you action points to what to do. But if we sort of kind of look at the themes that we like, we are clearly very long energy. We are very long commodity equity. We are very long defense spending because, of course, unfortunately, the world is moving towards increasing military spending. We are long logistics because the physical world is too small for all of the aspiration of fiscal, monetary, and green transformation that goes on. And we are long cybersecurity because cybersecurity has become a key factor to keep and operate a business in the world today. And then the logic ticket that we run, of course, is on biotech, considering that we think the next frontier technology-wise is actually this precision medicine, this ability to simulate animal testing on a computer instead of animals and the likes. But as you can see, a lot of our investment in the equity side is what I would call the real world. It's tangible assets. And maybe if you allow me to go into the helicopter for 1 minute, explain why we are like that. If you look at the S&P 500, so the 500 biggest stocks in the US, 90% of all the valuation is in intangibles, which means intellectual property, non-buildings, non-manufacturing. So we have a world today as we talk where 90% of the economy is, let's call it what it is, digital, and 10% is the physical world. It is impossible for the physical world at the size of 10% to deliver enough juice, enough electricity, enough baseload, enough grid, enough capacity in terms of harbor, airports, internet. So what do we get? We get inflationary pressure because we have underinvested into to these resources. So for now, on the equity side, we are very focused on this play between tangible, or in other words, the real economy, and in the non-real economy, the digital economy. It doesn't mean we are negative on technology. It just means that we think that for the next 5 to 10 years, you want to invest in something which is part of the solution on the energy side, on the environment side, on the defense side, on the way that the world needs to move to an agenda which is more real capital and less eyeballs, fantasies about getting Amazon to deliver your underwear 1 day early on a drone. I mean, very neat, very appealing from a headline, but not really productive. What is productive is to invest in the real economy.
Yeah, that's a great point. It's like pick molecules over the bits, right?
Yeah, exactly.
Great. And what about the bonds and commodities? I mean, within the buckets, if you could just mention the.
Yeah. Through most of last year until October, our fixed income exposure was floating. So instead of having a fixed coupon, we decided to buy. And I need to add, you can do this 100-year portfolio with less than 11 ETFs on the Saxo platform. You don't need hundreds of names or whatever. You can buy 11 ETFs that reflects the themes that we now talk about. So we bought, and I was long a floating rate ETF, which of course didn't make money, but it lost significantly more money than a fixed income coupon from the government of Germany or the government of the US. We then changed that to long credit risk. In a country like Denmark, we were used to minus 0.5% in interest rate. I mean, you were actually paid to borrow money to buy a house. It sounds totally wrong, but that was the case. But during 22, mortgage rates in Denmark, which is AAA rated, never had a failure, moved to 5.5%. And then, of course, it's an easy nothing is easy. That's the wrong word, but it's very appealing risk-wise to buy something that yields you 5.5%, AAA rated, the Danish government, Danish system, and you could find idiosyncratic risk around Europe or the US for the same. So what we did was we went from floating rates to higher exposure in AAA and AA credit exposure in order to get the extra yield, but also because we felt very confident that the world ultimately, and we will talk about that later, in 23 was closer to the peak in interest rate than it was when we started 22, obviously. So, yes, we can still see higher interest rate in the US and in Germany and Europe, but the distance that we can travel in 23 has to be significantly lower than the distance we travel. And getting paid that extra premium, so it's 5.5% for an economy which have an inflation risk of 2, let's call it 3%, is of course a good risk reward. And remember, we are long term, so we are buying a bond at 95, 94. If in worst case it gets 200, we are really not in a position to take risks. So I think if you're starting up a new portfolio, the fact that now bonds pays you a yield is probably one of the most positive we've seen in the last 10 to 15 years. So we really like that aspect. We remain, as we will talk about later again, very bullish on Fed going higher. But we also think the market constantly will try to fade that. But so that's that part. On the commodity side, we like to play the broader indexes. So we are really in commodities about the harvesting the backwardation. As you probably know, at the height of the market in 22, about 15 global commodity markets was having a backwardation. And in backwardation, you actually get you go long the future or the asset, and you are paid to be long that asset that everybody wants. So the harvesting yield from being in backwardation on a typical balanced portfolio in the ETF space were at the time 8 to 10%, and now it's 4 to 5%. So in other words, we are long an asset which the world needs, which is more base metals, more energy, more natural gas over time. And while we wait and while the market trades sideways to a little bit lower, we are still getting a relatively high yield for being long that. So that's really what drives our bullishness. And then we continue to think, as I said before, if you want to grow the physical world, what do you need for that? You need more investments, you need more energy, you need more logistic, you need more, again, and then the whole theme, of course, goes back to the beginning. So those are the three bigger components, as you rightly pointed out.
Thank you. Yeah, that makes a lot of sense. And I guess that's kind of makes a good transition to our next topic, which is macro and markets, right? So, Steen, what is your take on 2022 in terms of macro dynamics, and probably what surprised you the most, and what went more as according to your expectations?
So a lot of clients at the end of 22 came to me and said, "We can't understand. We lost so much money, and the market's so negative." And with a smile, I sort of responded, I can't understand why you cannot understand why the market is so much down, because what of course happened in 22 was that the Federal Reserve, and they pre-announced this already in November the year before, said, listen, the focus for this only the second time in our 100-year monetary history is going to be to fight inflation. They were backed 100% by the White House on this agenda. So we went from an economic environment where we were loose on every aspect of monetary, fiscal, and every sort of obstacle we met in micro-wise was met by lower interest rate or higher debt financing. Then in November 21, the Fed indicated, and the market started to understand early parts of 22, hang on, the Fed is real, the Fed is actually going to do something. And then, of course, what we saw that despite the disruption like the Ukraine war and others, we saw that Federal Reserve moved on to increase by 450 basis points, which everything being equal is one of the steepest, one of the strongest hikes in monetary policy that we've seen in US monetary history. With that, you immediately change the discount factor for all these technology companies. The technology companies benefit from a low discount rate because, of course, if you have very visible high earnings in Microsoft, in Apple, in Google, when you discount that with a very small number, you get an almost infinite number. Now, all of a sudden, the interest rate went from, let's call it 1% to 4%. So you lost 25%. So without these companies actually doing anything better or worse, the value of these companies came down 30, 40, 50% by basically resetting the economy. I would say as a long-term trader and an economist, what really happened in 22 was that we had price discovery, and economists talk about price discovery as something where the market dictates what the price of money is. I think the last 15 years, pretty much we have been dictated what the price of money was because, the 2007-8 crisis, it was dictated by the central banks, and going all the way back to 87 when Greenspan came into office, we've had a steady state of lower interest rate and lower inflation as the medicine for an economy that didn't have productivity. Of course, that is a disconnect. What the world is to get less inflation, we need to be more productive. How do we get more productive? We need to invest in real assets. So for me, it was a pretty clear story of the market through inflation being reset on a higher interest rate. And going forward, I also think that is the story. We will have a hard time going back to Western inflation rates, which used to be 2% roughly, because that's been the target. It's going to be very difficult because we are so far behind on investment. We are so far behind on defense spending. We are so far behind in terms of productivity gains that we now see that wages is becoming a bigger part of the inflation rate. So, put very short, the price of money went up and the market reacted as it should, which was to say companies with very high earnings should be discounted, and companies with no earnings should be discounted even more, simply because the ability to raise capital in a market is very difficult. And don't forget, a lot of technology companies really raise money through giving options to the employees. And if the strike of the stocks like in Meta or Google comes down and down and down, these people are not making any money. They're actually losing money. So the compensation needs to come through salary and not incentive structures. So all this sort of fed onto each other and became a big story. And of course, throughout the year, we were short energy, we were short logistics, which is the theme I have now repeated, I think 9 times. So I'll stop there.
Mm-hmm. Okay. Yeah, and this now takes us to 2023. And what are your expectations? What do you think is going to happen? And of course, first thing is inflation, right? So do you think that we've reached a material peak in the kind of longer term, or do you think there's more pain to come?
So I think, not avoiding the question, but I'm going to rephrase it and say what is important is what the long-term average inflation is going to be. So it's not about whether we're going to peak at 10 or 11 and that was the peak, or it's rather the conversation about, can we go back to 2%? I will see 2%, which is an inflation target by most Western central banks, and I would say absolutely resounding no. It's very unlikely we get back to 2% certainly inside 23, but also inside 24 and 25. I think, and I'm using in my models an inflation rate which is 2x what it used to be. So in the case of Western Europe, we've had 2% inflation. I'm now operating on that. Yes. Answering your question direct now, yes, we can come down from like 7-8% to 5 to 4, but we are not going to 2. And that is critical because the market right now is pricing the forward curve on Fed, the terminal rate, the end rate of Fed, and the inflation rate on the basis that we go back to 2. I may be old and cynical, but if you don't change anything, I don't think anything changes in society. We really need to see higher investments, in particularly in energy and in energy security, to safeguard a lower interest rate, a lower inflation. But if I wanted to put headlines on this, I'll say the market right now is trying to handicap. They're trying to put us between having a soft landing and a recession. I have a few slides which I think is funny, because in October of 22, a number of my competitors, they were out with forecasts that would 98% probability that the US will be in recession by Q4 and Q1. And here we are. We just had the GDP number from the US. It was 2.7%, 2.5%, sorry. So we are so far away from recession as you can actually be. Another point is that recession, you need to define to me, what do you mean by recession? Do you mean the economics way of doing it, which is 2/4 of negative real rates? Then, it may happen. But in terms of our economy right now, if you have an inflation of 6 to 7%, your top line growth in your economy is 6 to 7% because of inflation, right? So it doesn't feel like, it doesn't act like, it doesn't smell like it's a real recession. So people have to be very difficult when they navigate these words of inflation and recession, because if we're going to have a proper conversation, we need to define what is it that you mean. And for the record, there are no definition of inflation, and there are no real definition of recession. I think everyone thinks there are, but there isn't. The great Paul Volcker, which is the former Fed chair, he's considered one of the biggest and best Fed chairman ever in history. He always said in some part of the economy may need 2%, some may need 0, and some may need 6%. So inflation is not one number overall for the whole economy and at all times. We assume that because we are not very smart in the world today. We continue to want headlines and one-dimensional models. But cutting it short, the market is trying to price recession versus soft landing. Soft landing is ahead right now, 60-40. It's, in my opinion, it's not going to happen, but it doesn't matter because the market is bigger than my opinion. But the rally we've seen is supported by a very easy financial conditions. So the overall monetary policy is very loose, is very easy. It's actually easier today as we talk than it was when Fed hiked interest rates. So Fed has hiked 450 basis points, but the overall conditioning of the economy is easier than it was a year ago. The dollar is weaker, volatility on bonds is down, and not least the forward curve on Fed is now indicating that we will have 82 basis points of cuts in the next 18 months. Those 4 factors on their own is positive for the market. What sits against that, the recession call, is that it's only a matter of time before the economy slows. It will show up in the earnings reports, some of them that you get, on a quarterly basis. And the most negative is saying, the U.S. companies in the S&P 500 should be making on an average year in earnings $230, $240 overall. Some people has it all the way down at 180. To that, you multiply the PE to get what did you expect for S&P 500. So basically, you have a range from the people who are supposed to be smarter than me, of the S&P being either 5,000 or 3,000. That's the spread, and that is really the conversation between soft and real. What the headline I use for the market is the two and done. So the market thinks we will have a hike from Federal Reserve in February and one in March, and then it will go to a pause. That is based on what we just talked about, that we have peaked in interest rate, we have peaked in inflation. I think because we have easy financial conditions, because we are unresolved on energy, and because the wages continues and the labor market continues to be full employment, we really have a story of two halves, a relatively risk-on positive Q1, maybe into Q2, and then a second part when inflation starts to come up again. And we may even see that already in the January numbers that we see on inflation, because gasoline, for instance, which is a critical part of the prices in the US, they are up 12% from the low. We see that the wages and the pre-announced increases by companies, retailers, are coming through in January. They were announced in Q4, but they're actually going into the shop in Q1. So you have this funny market where it's two and done, so two more hikes and then pause is the consensus. The underlying economy is much stronger than expected. We don't have a recession. And if anything, the loose monetary conditions combined with the inadequate investment into energy and research and infrastructure means that there is continuing an underlying strength, which again, for me, just makes me go back to my 100-year portfolio and say, I need exposure to all of these components, in the equity bracket. If I'm wrong about Fed being done, then I'm going to earn money there. And of course, equity is going to kick in with that story. On the other hand, if they're continuing to do it, I need to have enough risk premium to pay for the loss in price in fixed income. And the equity market, I'll continue to buy, while I expect that the reason for this being that we don't have enough energy, we don't have enough commodity, we may see even gold start to rise as well. So for me, I know I said a lot, but really two and done is the concept. Soft landing versus recession is what you need to handicap as an investor. And for me, I've been long risk until today. I've been very long risk, long every component in that speculative part that we talked about earlier. Now I've taken that off because the data incoming and the next Fed meeting, the next earnings cycle, I think it's critical before we can evaluate where we are in the market. But not negative, but positive based on what the economic data shows me. A little bit concerns about the future because I think inflation is coming back.
Yeah, I tend to agree, actually. I think that the soft landing scenario has been somewhat prematurely priced in the markets right now. And it could be, especially given the jobs market, I mean, the level of unemployment and the wages rising, it could be an upside, right? And
right.
Of course,
I just want to say that we are priced to perfection, and as far as I know, nothing is perfection, right? We always can do better. So it's really a matter of that. The best scenario for rates, the best scenario for inflation, the best scenario for the growth and labor and everything is priced as if it was perfect, and that's fine, and that explains why we are where we are with an excellent start to the year. But if you want to look a little bit ahead, as you rightly say yourself, you need to be at least aware of what can change from this perfect scenario.
Yeah. And of course, I wanted to add that with your approach, when you have this monthly rebalancing, I mean, even if you have this eventual correction and repricing of the expectations on rates and inflation, you even then you have this upside that you will have probably fixed by the time the correction comes.
Right. Let's just say use the 10%. I think it's a great point, because let's say we up 10% roughly in equity for the first month, then we rebalance 3.5%. So we actually put 3.5% to the side already, right? So we are up 3.5%, which we take the profit on. We still keep the exposure, but we are ahead by 3.5% in equity, which means that we need to lose those 3.5% first before we actually do anything. And the only thing we have done in the process is that we are buying the market the 35% cheaper than we originally did, right? So that is how it works, and that's why this works over time. It doesn't safeguard you from losing a little bit of money, but it takes away being long only equity and being down 50% or 40%. It's you usually expect your range to be -5, -10 in the worst case, and then plus 25 in the best case. So you're skewed positively to the upside, and you're sort of indirectly limited the downside, at least in the history we have of the portfolio.
Steen, another topic that I think has to be covered, I know that we are limited on time, but still, China reopening. How do you think it's going to affect the growth, the inflation, and commodities kind of issues?
Super question, and I'll be very surprised if the 180-degree turnaround in Chinese policy on zero COVID is not the biggest macro event in 2023. For me, of course, it's early days and it's too early to call. There could be something terrible or good happening later in the year. But you're absolutely right. And the easiest way to reflect this is that 1 percentage point increase in GDP in China spills over with 0.25% growth in the US and 0.35% to Europe. So why are we seeing European outperformance? That's because simply they are more exposed to the opening up of China. What in terms of China, a lot of people already get a little bit disappointed about the lack of follow through. But you have to remember, when you go from zero tolerance on COVID to opening up fully, the first thing that will happen is a lot of people gets infected, so the economy slows down initially. I think we are past that peak of the impact of that. And then next phase is going to be a pent-up demand with the consumers. They have been effectively closed down as an economy for 3 years. So I expect the consumer sides to pick up significantly. And then third, and most important for you and I as investor, is how is this Chinese government going to play this credit impulse, this increase in credit facilitation? How are they going to raise the money? How sustainable is it? But it's pretty clear that it is across the spectrum the widest relaxation that we've seen in monetary condition, in credit, in support of the economy. The one thing I will point out, which is still a risk, is that the Chinese banking system, which is classically used to leverage the economy and from which the Communist Party execute all its power. So basically, they use the banking system when they want to increase credit. They use the banking system when they decrease the credit. But the issue at hand, and something that needs to be solved over the next 6 months, is that the Chinese banks are out of tier one capital. So in other words, in order to increase the balance sheet, they need to get more capital, either through issuing IPOs if they are publicly listed, or through some guarantee mechanism like mortgages, a mortgage institution independently of the bank system. So there's a little bit of conversation going on in China now on how they raise more leverage into society. But I think the speed with which and the impact in terms of new initiatives that China's done means that it is almost inevitable that we see an increase in economic activity. I mean, they've been operating, in my opinion, at something of 70% of the 100% they can do. So going from 70 to 80 to 90 to 100, that impulse is worth to the rest of the world probably the magnitude of 0.5% to a full percentage point over the next 2 to 3 years. With that, of course, something Kazakhstan is going to benefit from is increase in demand in minerals, in commodities, and of course oil could be the big one. People seem not to appreciate fully that in 22, the winter of 22, China didn't really buy gas. They didn't really buy a lot of oil because they were again running at 70%, so they didn't need it. Now China is going to be one of the major bidders, one of the major actors in terms of bidding up. So that China on its own leaves me very bullish on a commodity ETF, which I expect an excess return of 10% on. But of course, we need to see this transmission of new initiative from a lot of people getting hit by COVID disease, then recovering, hopefully most of them, then the pent-up demand being released, and ultimately the impact that we see from the government. So this will make recession at a minimum less likely in the rest of the world, and most likely it will increase the pressure on prices and commodities. That's relatively short for me.
Yeah, it's a great insight. I think, and that could be the pressure on commodities from the demand from China. It could be one of the reasons that the current soft landing narrative could be shattered, right?
Exactly. And just for the record, soft landing it's like me being re-elected to play for the Danish football team at the age of 58, right? It's very unlikely to happen. So that it's not impossible, but let me put it this way. I'm not going to play for Denmark, and I don't think a soft landing will ever happen. So something between a soft landing and a recession is the most likely scenario, which is, as you say very rightly, that the soft landing doesn't become a recession, but it becomes something where Fed needs to keep monetary policy tighter for longer. And that will disappoint the market, and the pricer will have to reprice the price of money. My concept of 4% inflation long term instead of 2% become prevalent, and then the discount factor will be a little bit negative on growth stock, but very positive on the commodity sector. That's And again, I have no predictability, so maybe your viewers should just do the opposite of what I say. But that's at least my high probability scenario. Not a soft landing, not a recession, something in between, meaning exactly what you just said.
I see. Steen, if you allow a final maybe part of our interview, which is more related to kind of positioning that you're seeing. So your institution is quite big, right? And is there any extreme positioning that you're seeing, maybe too much pessimism at some point in the end of last year? And also maybe comments on liquidity. Do you see any disparities within bid-ask spreads for different instruments in very kind of bearish cases or periods of time?
Absolutely. So let's start with the easy one. In fixed income, we are seeing the spreads going up. We see it's becoming more and more liquid, and we see the same in the equity market. One reason is that these 0-day options that we see in the market, and that is not only a rage, it's a continuation what we saw during the COVID. You remember everybody was buying these meme stocks and everything else. The new meme stocks is really the 0-day. So 0-day option is that on a Friday, you know that non-farm payroll is coming out, and then you buy an expiry at later that day. This is grown massively in size, and it of course means that the intraday range is very big, but the day-to-day range is relatively small. Hence, we see that volatility in VIX is small. So that is, in my opinion, the greatest excess, the greatest concept in the market, that people are just throwing, willing to buy at constantly calls on the markets, seeing the upside. I think they're going to run into issues in January and February, because inflation will then start to be better than expected. And then, of course, you will probably see the market, there's not enough puts in this market, so the market could be a little excessive. But the 0-day options phenomena is, by my opinion, the single biggest illiquidity concerns we have. It looks like the market is trading a lot of stocks, but what they're really doing is they're taking zero risk with 0-day options. They call buy, spending money on those, and three weeks in a row, and they lose money and that disappear. That is what I see. And then as you
what's the largest name? Was it Tesla?
Yeah, of course, absolutely. I mean, it's very easy to do actually as a pyramid. You take the highest volatility stocks with the highest volume. So if you combine volatility with the volume, you get what it is. And of course, number one being Tesla, up 50% so far this year, right? So yeah. So Tesla. And then you can go down the order of what has the highest volatility of the bigger FANG names, and you can see what is trading in that. Absolutely, clearly indication this 0-day optionality. And both you and I smile, but it's pretty sad, isn't it, that the market is reduced to buying lottery tickets instead of, because I know, and I certainly think that, again, if you want to make money long term, you got to be making money short term, and you're not going to make money buying a lottery ticket. I mean, that is not how the market operates. But for now, they're smiling and I'm crying, but I'm pretty sure I've survived for more than 30 years. I'm going to survive another few years before. I'm not sure the people buying 0-day option is going to survive. It's going to ultimately cost them a lot of money, like it did with the meme stocks.
Yeah, I think it can be good. It can be bad for business as well, right?
We are a platform, but to be honest, that's and now it's going to sound almost holistic, but I think what's really changed over the last 10 years is that companies like mine and yours, we realized that having customers for longer is far more important how much money you make in the next quarter. And it sounds very like I'm a saint or whatever. I'm not saying that. I'm just saying that if you really want to have good business, what you want to secure is that your company, you have to, as you say, a good relationship between execution and price. So the access to execution and price needs to be in balance. You need to have, a personal touch support, but also you need to have advice and directions and thinking, which is that we invest in these clients in a mutual beneficial relationship for more than a quarter. 0-day option is high volume, high potential earnings, but it's not building you a long-term client base. It's doing exactly the opposite. You become, slave to try to be the smartest and the most headline-driven house in the world. And we are not like that. We don't even believe our own research. Our research is done to provoke your clients to think. It's not because we think we can predict the markets at any time. I mean, we do this famous outrageous predictions, as you probably know, and everything else. And it's just it's in positive meaning, it's a provocation to people to think differently and what are the risks, what is the upside, and is it too skewed? And as you rightly point out, right now, well, there may be earnings in having 0-day options, but that's not going to give you good clients over time.
Yeah, absolutely. Being long-term is also deeply rooted within our strategy as well. So it's an important topic that we try to raise with the clients as well. Steen, and also just maybe last question on liquidity, right? So liquidity, there's a growing concern that maybe the first quarter of 2023 is the liquidity is higher because of the debt ceiling and because of the drawdowns from the Treasury general account. And that might change later during the year, and with the Fed that could be more active in reducing its balance sheet, the liquidity could dry up. What are your thoughts on this? How can it influence the market?
Exactly as you say, there is this, as we call it, the plumbing of the system with the TGA account, the Treasury General account, and everything else. You have, you only need to go to Twitter for 1 minute, and you see 50 charts on how M2 is the most negative it's ever been year over year. You have every single central bank in the world except for Bank of Japan retiring liquidity. But remember, Japan's impulse on printing money is bigger than the majority of all the other banks, right? So not only do you have the TGA account, but you also have Bank of Japan due to their yield curve control, where they buy bonds and mass. And if you buy bonds as a government, of course, you create capital to the people you sell or you buy from, right? So the system from Japan is flowing over with excess return. I think that ends inside Q1. Kuroda, the BOJ chair, is stepping down after the March meeting. So one thing on liquidity you need to monitor is Japan's impact. China is coming with a credit impulse, which is a positive liquidity impulse itself, but it's coming through more the real economy than through the financial economy, as you talk about. So not concerned about liquidity in the short term, but totally agree that the slimming down on the balance sheet in Fed is still a story that needs to be executed. Right now, it's only the policy rates that have been going up. The amount of trimming that we see, the reduction in the balance sheet has been minimal. And now we have this one-off incident that we seem to have on every 10, 12 years of a potential lockdown in the US economy. Last time was in 2011. The market collapsed 5% at the time, but came back, even though US at the time was temporarily downgraded from AAA. But I don't see that as a major issue, but I agree with the flow right now is positive for the market. And also the dollar being weaker. Don't forget, if you only had one liquidity factor, if your clients only needed one indicator to look at, they should just look at what have the dollar done over the last month. If the dollar is weaker, it's provided more liquidity. If the dollar is higher, it's withdrawn liquidity from the market. So everything points to a relatively easy monetary stance right now. I totally agree with that. But that is also due to change as we come into the second half.
Thanks, that's very insightful. Now, maybe to wrap up, I've seen some of your interviews, as I mentioned, and I like this thought very much, is that, the cost of money is higher right now, but that makes everyone incentivized to be more effective. Could you maybe say a few words on that?
Yeah, I mean, another way to explain that is that everybody told me when we had supply chain issues that Fed could not impact the supply chains. And I said, yes, they are. Because if they are operating with a guidance, with an interest rate which is 0 or 0.5%, what they're doing is they are crowding out. They are making sure that people only buy non-productive, assets like fantasy apps and social Weight Watchers, whatever, all these stuff that you can do online, Amazon discount rate. But instead, as right now, that you have the fact that the average cost of capital for S&P 500 companies has moved up to 6 to 7%. Then think about it, 6 to 7% is the minimum return on capital you need to start a new project. When the threshold is 0, you don't need anything. You just need, to create enough PR and marketing to get the money flowing, because there's enough liquidity and the price of money is so cheap that you can fail. At 6%, it becomes more a game of finding the right resources, the right research and development, the right amount of productivity built into it, because you can easily create from an investment 1 to 2% return just based on inflation. But if you get to 6 to 7%, you need to embed a productivity. And when you embed productivity, we're talking about a concept where you cannot lose money. Simply, I mean, the whole concept of productivity, you can't lose money, because of course it is cheaper. You get more out than you put in. That is productivity, right? So for me, the focus on a higher minimum interest rate for projects and investment increases the threshold, but also the productivity share or the component of it. So from that perspective, I think it's the best thing that happened in the last 25 years, that the threshold the threshold interest rate goes to on average 6 to 7% minimum for AAA, and even 10% for non-AAA. What does that mean? It means to need to find an investment that gives a return on capital of 10%. That can only happen if you're productive. What does that do? That reduces the inflation, that improves the inequality, that improves the dynamics of the economy, because productivity is the only thing. I mean, I know I studied economics more than 30 years ago, but if you take all of economic lessons in 1 second, there's only two things that matter. Demographics, because of course, how many people is working and living and being productive, but more important, productivity. Everything is as you said earlier, mean reverting. Investment is mean reverting. Trade is mean reverting. Government spending is mean reverting. Inventory is mean reverting. What is not mean reverting is productivity. That's been on a negative slope forever. Now I'm the most positive I've been in 30 years. I think the next 10 years in macro is going to be the most positive. Why? Because the threshold investment rate that you need to get return dictates by itself that we need to be productive. Otherwise, we're going to fall into a trap where we forever will have low interest rate, maybe high financial return, but a real economy that gets smaller and smaller, so much so that it breaks.
That's a great thought, and I hope that exactly what happens going forward. Well, Steen, thank you so much for spending so much time with us, and it's a great pleasure, and we look forward to following your thoughts and your research, which just to remind our audience, which can be found on Saxo webpage, right?
Yeah, analysis.saxo is all our research. Analysis.saxo should be the quick route to it. And if I may do a little advertising, John Hardy, who runs the team on a daily basis, does a podcast. So for those of your viewers and clients who are inclined to do podcasts, I have nothing to do with it, so I can praise it. It's ranked one of the best financial day-by-day updates, and it's less than 10 minutes, and you have the best of commodities, best of foreign exchange, and better macro every single and equity every day from the 3 top guys at Saxo in English to your phone anytime you want it. So look up Saxo Morning Call on podcast. Really great rally. So much that even an old veteran like me, I listen to it and I learn something every day.
Thank you. Yeah, we will definitely check it out. Okay, thank you very much again, Steen. Goodbye.
My pleasure, and best of luck for the rest of the year.
Goodbye. Have a good one.